So welcome everybody. Recently I ran into this article of the Financial Times which talks about the Credit Suisse bank, and the question is, how big is the capital hole? So I would like to connect this article to the capital requirements ratios, and starting point is the following balance sheet. It stems from the Mankiw textbook, Macroeconomics, chapter 4. And here we have one balance sheet. Reserves are equal to 200, loans are equal to 500, and the bank also invested in some securities, so in corporate bonds, for example, of 300. On the right-hand side of the balance sheet, we have the deposits of private households, debt may be related to a different bank, and then the capital, the owner's equity, equal to 50. This is the initial situation, and the capital ratio is defined as equity over risky assets. And this ratio should always be larger than a limit which is set by the regulator. Let's assume that in our numerical example, the banking supervision sets the minimum reserve ratio to the level of 6.25%. In the real world, one famous capital requirement ratio is called CET1, or Common Equity Tier 1 ratio. The CET1 minimum requirements are to some extent bank-specific and definitely larger than our 6.25%, which we want to assume in this numerical example. So is the regulator satisfied right now? Let's compute this ratio. Equity is equal to 50, risky assets, this is equal to 500, the loans plus the 300 securities is equal to 800, so that this ratio is indeed equal to 6.25%. Reserves, which are on the left-hand side of the balance sheet, they are not a risky asset. Therefore, the reserves of 200, they don't pop up on the left-hand side. They don't pop up in the denominator of this fraction. So the capital requirement ratio is met, the regulator is satisfied, and the bank meets the required ratio. The bank operates just so within its limits. Let's assume that a shock occurs and the securities lose $10 in value. So some risky corporate bonds, despite the fact that they are called securities, they are to some extent risky, they lose $10 in value. So we have to write off the securities from 300 to 290. What happens on the right-hand side of the balance sheet? It is the case that the loss of $10 will reduce the equity from 50 to $40. So the bank balance sheet looks now in the following way, that the left-hand side is shorter and also the right-hand side is shorter by $10. The big question is, how does the capital ratio look like? Once more, equity over risky assets, that's now equal to 40 units of equity divided by 790 units risky assets. This is approximately equal to 5% and hence lower than the minimum requirements of 6.25%. What should the top management of the bank do? And there we can talk about two alternatives. The first alternative is that the top management says we need more equity. And the big question is, how much? So we have to find out how large has equity be so that we can meet these capital reserve requirements. So we have to solve this relationship for like the unknown variable. We have to solve this equation for equity. Let's do that. We compute equity in the following way: the minimum reserve requirements times 790. So we know that we need equity of 49.375. So the bank needs additional equity of the size of $9.375. So how does the bank balance sheet look like after we raise this additional equity? Of course, capital right-hand side equity increases from 40 to the level of 49.4 US dollar, and the additional equity is held as reserves. So also the reserve component increases by the 9.375 US dollar. What about our capital ratio? Is the minimum ratio met? Let's calculate. Equity is equal to 49.375 divided by 790. Indeed, now the capital requirements are met. Capital requirements are once more equal to the minimum capital requirements of 6.25%. How does this alternative one look like? Is it a realistic option? Yes or no? Like, the shareholders know that the bank lost 20% of its equity in the last year, so the investors will be reluctant to recapitalize the bank. It's very hard for the bank to get additional equity. One banker said in this Financial Times interview, "I want to be clear, we have not sounded out investors for capital." So what is the other alternative? The banker answered, "We'll be doing asset sales and divestitures to achieve towards a stable business." So how does the second alternative look like? We have to sell risky assets. We have to sell securities. But how much? So now the unknown variable is in the denominator of this fraction. We don't know the amount of risky assets we can have on our balance sheet when we have only 40 units of equity. So let's solve for the unknown variable. Let's solve for risky assets. And hence, we learned that 40 divided by 0.0625 is equal to 640. So we are allowed to have 640 units risky assets on our balance sheet in case that we have our equity of 40. So after the equity is down to 40, the bank can have 640 US dollar risky assets on its balance sheet. 500 US dollar are loans, which can be hardly reduced in the very short run. So the bank can only have 140 US dollar securities on its balance sheet. So the bank has to sell 150 US dollar in securities. How does the bank balance sheet look like? Nothing happens on the right-hand side. Equity is down to 40, but then 150 units securities are sold, so that securities are down to 140. And this additional 150 units are held as reserves. What about our capital requirement ratio? Is that met? Yes, 40 divided by 640, that's equal to our 625%. The overall chapter is related to monetary policy, the monetary system, and money supply. So, like, what are the implications for the monetary policy? The commercial bank we are looking at cannot expand loans. So the commercial bank will be restrained to give additional loans to private households and companies, and therefore money supply will not expand too much. Thank you very much for watching this short video. Have a nice day and bye-bye.